Have you ever noticed that the truly wealthy people, the ones with generational money, almost never talk about what they actually do with it? They don't post about it, they don't brag about it, and they definitely don't teach it in school. But here's the thing. The gap between how rich people think about money and how the rest of us think about money. It's not about income, it's not about luck. It's about a completely different set of habits, decisions, and systems that most people never even get exposed to. Today, we're pulling back the curtain. 7 specific things wealthy people do with their money, backed by real data that almost nobody talks about. Let's get into it. Welcome to VestWise, where we explain investing concepts in a simple way. Quick note before we dive in, this video does not contain any financial advice. Everything we cover today is purely educational, so you can make the best decision for yourself. All right, number 1. Here's what most people do with their money. They earn it, they spend most of it, they save a little, and they hope for the best. And look, that's not a character flaw. That's literally what most of us were taught. Work hard, spend less than you earn, put something in a savings account. But here's the catch. That formula? It's designed to keep you comfortable, not wealthy. Think of it like this. Imagine 2 people building a house. One person lays bricks one by one, hoping the structure holds. The other person first draws a blueprint, understands the foundation, then builds systematically. Both are working hard, but only one is building something that lasts. Wealthy people operate from a blueprint, and today we're going to show you exactly what that blueprint looks like, piece by piece. Let's break it down. Most people follow this order: earn money, then pay bills, then spend, then save whatever's left. Wealthy people flip it completely. Earn money, then save and invest first, then live on the rest. It sounds simple, but the psychological difference is enormous. Think of it like oxygen masks on a plane. The instruction is always, put your own mask on first, before helping others. Not because you're selfish, but because you can't help anyone if you pass out. Paying yourself first means your financial future gets funded automatically, before your lifestyle has a chance to consume it. According to a study by Schwab Modern Wealth, 59% of Americans say they live paycheck to paycheck. But among high net worth individuals, those with over $1 million in investable assets, the vast majority report having automated savings and investment contributions that happen the moment their income arrives. It's not that they have more willpower. They've just removed willpower from the equation entirely. Thing number 2, they buy assets, not status, 305. Here's one of the biggest mindset shifts that separates the wealthy from everyone else. Most people, when they get a raise or a bonus, immediately upgrade their lifestyle. Nicer car, bigger apartment, better phone. And there's nothing wrong with enjoying your money. But here's the thing. All of those things lose value the moment you buy them. A new car depreciates the second you drive it off the lot. The latest phone is worth half as much in 2 years. These are liabilities, disguised as rewards. Wealthy people think differently. When they get more money, their first question isn't, what can I buy? It's, what can I buy that will make me more money? Real estate that generates rental income, stocks that pay dividends, businesses that run without them. Intellectual property. These are assets, things that put money into your pocket over time. Think of it like this. Status items are like buying firewood. It burns bright, feels warm, and then it's gone. Assets are like planting trees. They take time to grow, but eventually, they give you shade, fruit, and warmth for decades. Thing number 3. They diversify across asset classes, not just stocks, 440. When most people think about investing, they think about stocks, maybe some bonds. That's it. But wealthy investors, and I'm talking about the truly high net worth individuals, they spread their money across multiple types of assets. And not just for safety, for opportunity. According to a 2023 report by Knight Frank, ultra-high net worth individuals typically hold only about 25 to 30% of their wealth in public equities, like stocks. The rest? Real estate, private equity, commodities, hedge funds, cash equivalents. Now here's the catch. Most of those asset classes aren't accessible to the average retail investor. Private equity has high minimums. Hedge funds require accredited investor status. That's a real barrier. But here's the key insight. The principle is accessible to everyone. You don't need to invest in hedge funds to diversify intelligently. You can diversify across stock sectors, between domestic and international markets, between growth and value, between equities and bonds, between stocks and REITs, real estate investment trusts, which are available to anyone with a brokerage account. The goal isn't to copy the exact portfolio of a billionaire. It's to understand why they spread their risk and apply that thinking at whatever scale you're operating at. Thing number 4, they let their money work while they sleep. This one sounds almost too simple, but it's probably the most powerful item on this entire list. Wealthy people obsess over passive income, not because they're lazy, most of them work incredibly hard, but because they understand one fundamental truth. There are only 24 hours in a day, and you can only trade your time for money for so long. The goal is to build systems where money generates more money without requiring your direct time and energy. Dividend-paying stocks, rental properties, index funds growing through compound returns, royalties, business ownership, all mechanisms where your capital, not your hours, does the heavy lifting. Think of it like building a river instead of carrying water. Most people carry water every day. They work, they get paid, they spend. Wealthy people spend time and energy building the river, the system, so the water flows on its own. According to Hartford Funds research, dividends have accounted for approximately 40% of the total return of the S&P 500 since 1930. 40%. That means nearly half of the market's long-term gains came from money simply sitting in assets and generating returns, not from perfectly timing trades or finding the next hot stock. The earlier you start building that river, the longer it flows. Thing number 5. They protect their wealth, not just grow it. Here's something most investing content never talks about because it's not exciting. But wealthy people spend an enormous amount of energy on protecting what they've already built. Insurance, legal structures, tax optimization, estate planning, emergency funds that would make most people's eyes water. Think of it like this. You wouldn't build a mansion and then leave it completely unlocked with no alarm system, right? But that's exactly what most people do with their financial life. They spend all their energy building and almost none protecting. Now here's the key insight. You don't need to be a millionaire to start thinking this way. The habit of protecting what you build, starting with a proper emergency fund, basic insurance coverage, and understanding your tax situation, is something anyone can begin implementing right now. According to a Vanguard study, investors who work with a financial advisor and implement proper tax loss harvesting, asset location, and rebalancing strategies can add up to 3% in net returns annually. 3% doesn't sound like much until you compound it over 20 or 30 years. Thing number 6. They are obsessively patient. Here's the one that nobody wants to hear. Because we live in a world of instant everything, wealthy people, the ones who built lasting wealth, not lottery winners, are almost universally defined by one trait: patience. Extraordinary, almost boring patience. Warren Buffett made 99% of his net worth after the age of 52, not because he suddenly got smarter at 52, because compound interest needed time to do what compound interest does. But here's the catch. Patience isn't passive. It's not just sitting there and waiting. It's staying invested when the market drops 30% and everyone around you is panicking. It's not touching your retirement fund when you hit a rough month. It's continuing to contribute when the headlines say the world is ending. According to research from Morningstar, the average investor underperforms the very funds they invest in because they buy high and sell low, driven by emotion. The fund returns 8%. The investor, because of poor timing driven by impatience, earns only 5 or 6. The wealthy don't outperform because they're smarter. They outperform because they stay. Thing number 7. They invest in knowledge first. And finally, the one that ties everything together. Before wealthy people invest a single dollar, they invest in understanding. Books, mentors, courses, Time spent studying businesses, markets, and economic cycles. Think of it like this. You wouldn't hand someone a scalpel and ask them to perform surgery after a 5-minute YouTube video, right? Yet millions of people put their entire financial future into investments they barely understand because a friend told them it was a good idea. The wealthiest investors, Buffett, Munger, Dalio, are all voracious readers. Buffett famously spends 80% of his workday reading, not trading, reading. Now here's the thing. This doesn't mean you need to read 500 books or get a finance degree. It means developing the habit of understanding before acting. Know what you own. Know why you own it.
Know what conditions would make you want to sell it. And honestly, that's exactly what you're doing right now. By watching videos like this one, you're building the foundation, one concept at a time. Let's put a real number to all of this, because the difference in outcomes is staggering. Imagine two people, both 25 years old, both earning the same income. Person A spends everything they earn, invests nothing, and starts thinking about wealth at 45. Person B implements the 7 habits we just covered, pays themselves first, buys assets, diversifies, builds passive income, protects their wealth, stays patient, and keeps learning. They invest $500 a month, starting at 25. Assuming a 7% average annual return, which is roughly the historical inflation-adjusted return of the S&P 500, according to Vanguard, by age 65, Person A has whatever they managed to save in their last 20 years of working, maybe $150,000, if they're disciplined late. Person B, over $1.3 million from $500 a month. That's the math of compounding, applied to the right habits, consistently, over time. The habits aren't secret. The math isn't complicated. The only variable is whether you start and whether you stay. So to wrap everything up, the 7 things wealthy people do with their money that nobody talks about. 1. They pay themselves first. 2. They buy assets, not status. 3. They diversify across asset classes. 4. They build passive income systems. 5. They protect what they build. 6. They are obsessively patient. And 7. They invest in knowledge before they invest in anything else. Now, does this mean everyone who does these 7 things becomes a millionaire? Not necessarily. It depends on your starting point, your income, your timeline, and your personal goals. But here's what I can tell you, with confidence. People who consistently don't do these things almost never build lasting wealth, and people who do, they give themselves the best possible chance, regardless of where they started. This is not financial advice, just knowledge, so you can make the best decisions for yourself. If you found this helpful, hit the like button and consider subscribing. We break down concepts like this every single week in a simple way, so money stops feeling complicated. And if you want to go even deeper, check out our video on the 7 investing levels, where we show you exactly how to progress from complete beginner all the way to building real, lasting wealth. It pairs perfectly with everything we covered today. Thanks for watching, and see you very soon. Bye.